Hey folks, and welcome to the Pipnotic Symposium for the 5th of August 2021. Today we are going to talk about liquidity distribution and liquidity exploration and what this means, especially relative to identifying high probability trading areas. So in order to understand this, we have to draw a rectangle like this. Okay, so this is the open of a period and this is a close. But within this you can have also, it can be a close, open, close, open, close, open, close, open, close, open, close, open, and close. Okay, so let's just assume for a second this is the beginning of one period, this is the next period, next period, next period, so on and so forth. So this is essentially what we'll see in the form of candlesticks or bars on a price chart. Okay, and so when you see something like this, what price normally does, depending on the time of the day, price will enter, rather the period will open, and then price will move sideways for any period of time. Okay, so it goes up and it goes up to a certain level, then it'll go down, it'll go up, and it'll go down. And during this sideways price movement, like you can see here, and like you can see here as well, and down here, and up here. Okay, and during these periods of sideways price movement, people are happy buying and selling from each other. Here you had like price leave and price leave, then price left. But during these periods, sorry, it's not very clear. During these periods of sideways price movement, people are happy buying and selling from each other. So people are in agreement of the price. Okay, and so this is perceived as an area of value. Okay, this is super important to understand. So when people are happy buying and selling, well, then price will stay in that area if the supply and demand at that price point, that perceived area of value, remains in balance. Okay, but sometimes you'll see something like this, where price leaves. Here it left a little bit, here it went above. This one went above once, it went above twice. Okay, and if we hone in actually on these ones here, let me do that here. So if you look at this, when we had an area here, we had another one here. Just going to draw these in so they're super clear. We had an area like this. We had an area like this. Okay, and so there you can have these micro levels and these macro levels as well. And so if we look at this one here, we had this area here. Okay, we'll do one more just here. Okay, and notice that price pops above and below all the time. The price came above here, came above here, went below a little bit, above a little bit, a lot. And then we have some other layers here. We've got this and this. Okay, and this is very interesting and very important, because when price leaves an area of perceived value, either quickly, traditionally quickly, this means that they are advertising prices that are more expensive if price goes above, or cheaper if price goes below, than this perceived area in value. And what's that going to do with the psychology of someone who's looking at entering a trade? Well, first of all, if price goes up, it's expensive, so people who have bought are looking to sell, or if people who have sold, depending on how they trade, they might think that this is a breakout, and then they are going to try and buy. Okay, and so you have also the notion of liquidity exploration, which we spoke about many times, most recently maybe a month or so ago in a video where we examined a turning point in the market where price went up, and then it went like this, and then it went up, went down, and then it left. Okay, and so this is very interesting. This is super important, because when you have this perceived area of value, people are happy. When price goes above, you have several things going on. Number one, you have breakout traders. Number two, you have sellers coming in. Okay, and there are obviously more, but these are the ones that we're going to focus on here. A breakout trader in a situation like this, when price goes up like that, he is gonna look to buy, and the most obvious place for this person to put their stop is going to be below this price structure that you can see in the white box. Okay, and then you're going to have the sellers, and the sellers are just going to, they see price going up like that, they understand what is actually going on, which this is a liquidity exploration, so we're advertising higher prices. We're releasing short sellers liquidity of their positions into the market by running through their stops, because stops are always going to be located around price structures. We have price structure here, we have a price structure there. So if price runs above, we're going to hit stops. What does that do? Well, that dumps the liquidity available at these price points into the market that can then be used to facilitate the filling of orders for the short sellers. Okay, so when this happens, and assuming just for a second that you have people who are looking to buy the breakout, they put their stops here. Okay, but the people who establish the marketplace, they know this very, very well, and so they know as well that if they have a big order on their books and they need this order filled, but there isn't liquidity available at that level to fill the order, then they have to go looking for liquidity. So this is what I refer to liquidity exploration, where they will explore releasing liquidity into the marketplace, and this liquidity is often in the form of stop losses, protective stop losses. So when price goes up like that, people put their stops there, and so what you'll see very often, I'll draw it here, where you have price come up, it starts to go sideways, and it'll go up, and when price goes up, stops are placed here, and people buy. And so if you have a big order that needs to be filled, they don't have liquidity available, then they'll run price, they'll shake people out of their positions, and then they can drive price above and high, and then price will go down, and it'll kill the stops here. Okay, and then it'll form the notion of many that price is going down, so now it's time to sell. And so then they'll put their stops there and they'll sell. But then the market will very often do this again, and it'll run through the stops before it figures out what it's finally going to do. Okay, and this doesn't mean that the market's against you. It just means that this is the way the market works. The people who create the market for us, they have orders on their books that they need to fill, and if the liquidity is not in the marketplace to fill these orders, they need to find it, and they can find it by doing liquidity exploration in any of the ways that we've just looked at just now. So when you see something like this going on, which you'll typically see at key turning points in price and also continuation patterns, which is why we focus on these continuation patterns and origin, supply and demand, this is just the market doing its thing. So let's see if we could find an example. And I actually found this example just here, which is very interesting, where we have price. Okay, price formed this area of perceived value. Okay, so price comes up, we go through the highs, and we start forming this perceived area of value. So people are in agreement here, and price goes up, and then we leave. And so a lot of people think, okay, we're leaving, we want to sell, so they put their stops above here maybe. Okay, price goes down, it comes back, it goes down, now they think they're in the money. Okay, but then the market is driven up north, we hit the stops here, so this is removed, then they leave, price moves sideways again, and then we leave. So what's happening here is we are actually seeing the same thing occur, because we can see where price leaves. You don't have to guess. You don't have to see price enter a place and go up and down like this. You don't have to guess. You don't say, I think it's going to go up, I think it's going to go down. You just have to wait. When you see an area like this, like we trade 1,000 times before, an area of supply, and you have the same thing going on here, as you can see here, but we don't have to guess. You don't put an order in to buy or sell in anticipation that your thesis plays out. All you have to do is you have to wait for price to leave. And when price leaves like that, the underlying flows are showing you exactly what's going on. And typically when price is high, the major flows are going to be looking to sell. When price is low, the major flows are going to be looking to buy. When price goes down, look to buy. When price goes up, look to sell. And so this is opposite to the way many people look to trade the markets, because when the price is going up, this is for many confirmation that it's time to buy, but this is not always the case. I've drawn this several times before, this little graphic where you have because you have a metric where you have this, you have a line here, you have a line here. Okay, so this is time, this is volume, and right here we have the spot price, so I'll call that. Liquidity will look like this. The closer you get away from the spot price, sorry, the further you get away from it, the higher liquidity. So this is lots of selling liquidity, and here you have low liquidity, which is close to price, and you have bearish liquidity forming at the bottom, like so. So price will come in here. Price doesn't do anything, and you'll also notice that very close to price, it's easy for price to move far, and that's because the liquidity available at these areas is very thin, enabling the facilitation of pushing price higher or lower. Okay, so you'll see price do this, it'll go up or it'll go down or whatever, but it tends to slow down once it comes to the upper limits and the lower limits of these pools of liquidity, which are typically high when price is high and high when price is low. So here we have selling and here we have buying, and this is happening all the time on every time frame. Okay, so when price stays close to spot price, the liquidity is pretty low because people are just kind of buying and selling at value. Okay, perceived value, always perceived value. And I say perceived value because no matter what price anything is for sale at, it'll always be an attractive price for somebody. Okay, always. And so you can have prices very, very high, and depending on who's buying and selling, that could be an incredibly attractive price for someone who has a macro stance on their economy and they are looking to buy. Compared to where price was 10 years ago or 5 years ago, maybe that's a really cheap price, and so they are looking to buy. But for the short-term trader, maybe they're saying, well, that's really expensive, it's time to sell. And both can be right. The only difference is their expectations and their time horizon. Okay, that's the only difference. So when you have perceived value like so, price going up and down, you can have market participants both buying and selling. And this is why price stays in areas for a long period of time. This here is thin liquidity. These are our liquidity voids, price imbalances. Okay, and this is the thick liquidity because price doesn't move as much. And then we have another price imbalance. Okay, here's the origin. Price goes up to here. Let's just ignore this bar because it's a mess. Price goes up, and then we have thick liquidity, and price goes down, and then it goes up. Okay. So that's why you see these moves all the time. So when price is doing stuff like this, there's an agreement in price. When price is doing something like this, there's a disagreement in price. We've spoken about this many years ago. I would always talk about liquidity, and I would use currency strength to help illustrate this, because currency strength is fascinating in that it shows you very clearly what two currencies are doing relative to one another. And so if you have, what pair is this? This is Euro, British Pound. So I'm going to put my colors on, the ones that we normally use. So we have blue. Okay, so when just around here, we're going to have a weak Euro. Then it's going to get stronger. And it's going to get weaker. Okay, and for the British Pound, which is red, using our software, the opposite is going to happen. We're going to see that the pound's going to pick up in strength. It's going to flatten. It's going to be parallel to the euro because we're moving sideways. It's going to get weak as the euro picks up. And then it's going to get stronger to bring it down, and then prices are going to flatten out. And the amazing thing about using currency strength, it brings to our attention what side the thin side of the market is located on. Okay, and so when you have the euro going down and the pound going up, the thin side of the market for the euro British pound is down. Okay, when they're sideways, like you can see here, we'll put yellow. When it's moving sideways, they're flat relative to one another. Price will move sideways. So this is thick liquidity, and then again we have thin liquidity as these two diverge from one another. Okay, and this piece here, you can see sideways price movement even when both currencies are moving higher together. If they're moving higher parallel to one another, then the price of the asset will be flat. But it can also be going down. If they're moving down at the same rate more or less relative to one another, well then price will be flat. I know that's a really weird, maybe difficult to understand, but that's the way it works. Because you're always considering the relative strength of two currencies, one relative to the other. Okay? And so when you see stuff like this, we have the origin to move, which is just here. We have a liquidity void, a price imbalance, and then price. So price leaves this area of perceived value to another area of perceived value. Okay, and in the wake we have this liquidity void. Okay, and these liquidity voids, as we know very well, tend to rebalance, and they do this because, I mean, when you have when price leaves like this and it moves sideways, price always rebalances at one point or another. And this is why we often capitalize on these positions where we would have typically taken a trade at this price point just here. Price imbalance, this shows us that we had value, perceived value. Price left, we had an imbalance. We had the order flows were bearish for this currency pair. A new area of perceived value. And then price returns to this area of perceived value. And the people who had orders on their books to sell, who did not get filled during this little perceived area of value, and the reason they didn't get filled is because you can't fill orders in a liquidity void like this. That's why it's called liquidity void, because there is no liquidity available, or very, very low liquidity. And if you have big orders to fill, it's not going to happen here. It cannot be facilitated in the anatomy of a price movement like this. There's nothing available, because if there was, it wouldn't move like this. If there was thick liquidity, it would look like this. When there's thin liquidity, it looks like this. Thin liquidity means there is nothing for sale, so there's nothing to buy, so price moves away to another perceived area. Okay, and so this one here, we stopped filling orders, price left, a new area of perceived value, and price returns to the origin of this move, and this is where we would typically sell. Okay, and these are happening all over the place on a price chart. Okay, good. Well, I'm going to leave it at that. If you have any questions, please let us know, and thanks for watching.